advisors. And Tony, let's start there. You have a new note. Are you buying today's pullback?
Well, Sarah, back in January, I remember you saying, wow, I'm surprised that you're more cautious. I'm not used to you being that way. And really, since last summertime, we've been talking about a tumultuous market outside of a year-end rally last year. And if you look at what has happened over the course of the last year at the low, when the S&P was down 14%, the NASDAQ and Russell were down 20%, you have to almost go back to the end of 2020 to see those levels. So you gave back all those gains and the markets had gone nowhere. But when you put all that into the background, we're still in a tumultuous market. I do think we're still going to pull back. But that thrust last week had a historic precedent that I just can't ignore. It's a hard call when you're in the middle of a war. You've got the Fed raising rates maybe 50 basis points at a time. Inflation's crushing the cost of everybody and companies. But a lot of times when you get the thrust like you got, so just to make it very specific, the S&P 500, we found that when it was up more than 6.95%, like it was in the 4 days that ended last week, so you had a 4-day rate of change of 6.95%. It was up 23% median gain a year later. 14 of the 16 occurrences were actually up double digits.
So that argues for more strength ahead. Richard, I remember you've been warning for months now about a bubble, even when things were looking good. And now that we have seen this sharp deterioration in the markets, do you think there's more room to go, or you agree with Tony? It looks like the damage is done.
Well, Sarah, I think, what you said, sharp deterioration in the market. I think I still view the market as being more of a seesaw right now, where the market itself really hasn't done as much as people think. But because people have been on one side of the seesaw, their pain has been extreme. If they've been on the other side of the seesaw, I think they're actually pretty happy right now. If you're in things like energy, utilities, things like that, I think you're probably pretty happy. So I think the dispersion among sectors and sector performance is actually the bigger story than the market, so to speak. And I think that's going to continue.
But would you add to exposure in those sectors that are doing well? Energy, materials today, utilities as well?
I think that there's a longer term story here. I mean, I think that one of the big surprises could be that energy is actually a growth sector. The energy sector right now has the highest dividend yield of any sector, so that would classify it as a value investment. But what most people don't understand is that on a bottom-up projected 5-year growth basis, energy also ranks #1 for earnings growth. So it's the #1 for dividend yield. It's the #1 for secular earnings growth. That, to me, sounds like a long-term investment story.